Mastering a day trading strategy that incorporates indicators like relative strength index, RSI, volume-weighted average price, VWAP, and bigger time frames requires a structured approach and thorough practice. Here's a step-by-step guide on how to do it. Understand each indicator. RSI, Relative Strength Index, it measures the magnitude of recent price changes to evaluate overbought or oversold conditions in an asset. VWAP, Volume-Weighted Average Price, it's the average price a security has traded at throughout the day, weighted by volume traded at each price level. Bigger time frames. These refer to charts with longer time intervals, such as hourly or daily charts, used to identify broader trends. Learn basic interpretation. Understand how RSI readings above 70 typically indicate overbought conditions, suggesting a potential reversal downwards, while readings below 30 suggest oversold conditions and a potential upward reversal. VWAP is often used as a benchmark for traders to assess whether they got a good price or not. If the price is above VWAP, it's considered bullish, and if below VWAP, it's bearish. Bigger time frames help in identifying the overall trend of the asset. For instance, if the daily chart shows an uptrend, it might be favorable to look for buying opportunities on smaller intraday time frames. Select a strategy. Decide on a specific trading strategy that integrates RSI, VWAP, and bigger time frames. For example, you might use RSI to identify potential reversals in line with the trend indicated by bigger time frames, and VWAP to confirm entry and exit points. Backtest your strategy. Use historical price data to backtest your strategy thoroughly. This will help you gauge its effectiveness and tweak parameters if necessary. Paper trade. Practice your strategy in a simulated trading environment without risking real money. This will help you refine your approach and gain confidence in executing trades. Implement risk management. Define your risk tolerance and set stop-loss orders to mitigate losses in case the trade goes against you. Monitor performance and adjust. Continuously evaluate the performance of your strategy in real-time trading. Keep a trading journal to record your trades and analyze what works and what doesn't. Adjust your strategy accordingly. Seek feedback and learn from mistakes. Engage with other traders, join trading communities, and seek feedback on your strategy. Learning from your mistakes and those of others can accelerate your learning curve. Stay disciplined. Stick to your strategy and avoid impulsive decisions based on emotions. Discipline is crucial for success in day trading. Stay informed. Stay updated on market news, economic indicators, and events that may impact the assets you're trading. This information can help you make informed decisions and adapt your strategy accordingly. By following these steps and dedicating time to practice and refine your strategy, you can master day trading using RSI, VWAP, and bigger time frames. Remember that consistency, discipline, and continuous learning are key to success in trading. Mastering a trading strategy with different time frames like 4 hours, 15 minutes, and 5 minutes can be a powerful approach for day traders. Here's how you can use them together. 1. Identify the trend, 4-hour chart. Spend a portion of your 4 hours analyzing the 4-hour chart. This time frame helps you identify the overall trend, uptrend, downtrend, or sideways. Look for price action patterns like higher highs and lows for uptrends, lower highs and lows for downtrends, or consolidation patterns for sideways movement. 2. Find entry and exit points, 15-minute chart. Once you have the overall trend from the 4-hour chart, switch to the 15-minute chart. This time frame helps you refine your entry and exit points within the larger trend. Use technical indicators or price action patterns on the 15-minute chart to confirm the trend and identify potential entry signals. Look for support and resistance levels for potential entry and exit points based on the overall trend direction. 3. Fine-tune entry and manage risk, 5-minute chart. Use the remaining time to analyze the 5-minute chart for even tighter entry and risk management. Look for confirmation signals on the 5-minute chart that align with your 15-minute analysis. This time frame helps you avoid getting caught in short-term noise and focus on high-probability entry points within the established trend. Place stop-loss orders to limit potential losses and take profit orders to lock in gains based on your risk-reward ratio. Tips: paper trading. Before risking real capital, Practice your strategy with paper trading using virtual funds. This allows you to refine your approach and gain confidence. Backtesting. Test your strategy on historical data backtesting to see how it would have performed in different market conditions. Focus on one strategy. Don't try to be a master of all. Choose a well-defined strategy and focus on mastering that before exploring others. Discipline is key. Trading requires discipline. Stick to your trading plan and avoid emotional decisions. Remember, there is no guaranteed success in trading. Mastering a strategy takes time, practice, and discipline. If you make it until the end of the video, you will be successful. Everybody gets sold the idea that becoming successful is this amazing and glorious journey, but in reality, it's not. Take dedication and discipline. If you made it this far in the video, I am proud of you. By now, 99% of people have already left. That you are still here, that is why only the 1% succeed, because they are willing to go through all the boring and repetitive stuff. And the fact that you are still watching shows that you're mentally part of the 1% because you have patience to watch this entire video. Well done, keep your head held high. Focus on one strategy. Don't try to be a master of all. Choose a well-defined strategy and focus on mastering that before exploring others. Disclaimer: I am not a registered brokerage firm or a licensed financial advisor. This information is intended for educational or informational purposes, and it should not be considered as a recommendation to buy, sell, or hold any stocks or securities. You are solely responsible for your investment decisions.